Welcome back to the Daily Nugget, daily property insights, 7 days a week. One question, 20 minutes or less. Myself, Lawrence Lodge, joined by Matt Harris, property tax specialist and a fellow property investor. And Matt, question to you today for the Daily Nugget, something I'm interested to know about because going through at this moment is the healthy homes costs. So pretty much the healthy homes ruling and the cost to implement those rulings in your rental properties. Can I claim them against my tax?
Great question. So I think let's start by just quickly talking about what the healthy home standards are, and then I'll get into how investors can claim or not claim. So the healthy home standards actually a relatively good piece of legislation by the government. It's probably a little far-reaching in terms of what you have to do as a landlord, but the general premise is that the government wants landlords to provide a higher standard of homes that are healthy to stop illnesses. And I think the overriding principle of that's totally fair, and I do agree with it. So it was passed into law in July 19. Most landlords didn't have to comply straight away, but you have to comply within 90 days of a new or renewed tenancy after 1 July 2021. So what that means is that most landlords have been complying within the last sort of 12 months. And so what you have to do to meet the healthy homes regulation is a number of things, but the most commonly understood is that there needs to be a heating source of some type, so a heat pump. There has to be insulation up to a certain level, and also there has to be ventilation in things like kitchens and bathrooms. So quite a lot of cost involved. A heat pump is going to run you between $1,500 and $3,000. Insulation is probably going to be about $1,500 to $2,000, depending on what sort of insulation you already have. Ventilation, depending on whether there's windows and things like that, it's internally or externally ducted. That's probably going to be at least $1,000. So most landlords might be looking at between $4,500 to $5,000 a house. A significant amount of money if you think about the average rental income probably being something like $35,000 a year. And that's obviously before costs of having a rental, interest rates, insurance, etc. So there has been a little bit of contention out in the community, and that's because not always will these costs be deductible. So to explore that, we have to really just have a really quick lesson on taxation, and I'll try to make it painless. So in New Zealand, important to note that residential property has a depreciation rate of 0%. And the principle behind that's actually sound. Depreciation is allowance for something that's reasonably expected to decline in value. Houses, by and large, do not. So therefore, the government has said that you shouldn't be able to depreciate them. Depreciation is a non-cash expense. So what that means is that you can have it, but you don't actually incur anything. And in the old days when depreciation was still allowed on buildings, when you sold that building, you had to recover it, but quite often people didn't. So what you have now in this space is you have a repair and a maintenance expense, which is something that is incurred to maintain an asset at the level that it was, or repair it up to its original level, but without substantially improving it. That would be deductible in the year that you incurred it. So an example might be a broken window, and you replace the pane of glass. The asset hasn't substantially changed. You've just brought it back to the level that it should be. Then you have depreciable property. So that's generally referred to as a chattel by a property investor. So that's something that's affixed to the property, but not an integral part of it. So something like a heat pump is definitely a chattel. You can remove a heat pump from a property and the property will still stand up. Carpets, curtains, ovens, stuff like that, chattels. So they're depreciable property, and that means they can be depreciated over a certain useful life. With a little nugget, sorry to reference the show, that if you have a chattel that's under $1,000, you can claim it in the year that it's incurred now. That's up from $500. So those are the two common types of expenses. Then you have a third little area called black hole expenditure, which is theoretically an anomaly in tax. It's something that probably shouldn't occur with good tax policy. So that's when you spend money, you can't get a deduction, you cannot depreciate it. Example of that would be something that you do to a building that substantially improves it. Common example is double glazing. So if you double glaze a property and it was single glazing before, that's a substantial improvement. That's black hole expenditure. You can't deduct it. So if we bring all that tax lesson and we look at healthy homes, the things that would be deductible would be the chattel part. So that's going to be heat pumps, surely. It's going to be ventilation nearly always, because you could remove that. But where you're going to run into trouble is where you put insulation in a building where there was none before. That is not a repair and maintenance. You're probably substantially improving an integral part of the building. Insulation goes behind walls and roofs and under floors and can be quite hard to remove. So I know that the Property Investors Association lobbied the government and asked them to make situations where landlords had to comply with healthy homes deductible regardless of the rules, and revenue predictably said no. So we're left with a pretty difficult area, and I think repairs and maintenance versus capital improvements versus chattels is something that most accountants, property accountants, have a bit of trouble with. Because there's lots of instances where there's a bit of a grey line, and you have to make a call. But ultimately, I think that most property investors should be able to deduct the majority of costs associated with a healthy homes legislation.
That's good to know. Myself going through it at the moment, it's in some instances, it's not that I've left my property and it's become expensive. It's just naturally expensive. A heat pump's $2-3 grand, doing extractors, everything bolts up, $5 grand, 10 grand, and so forth. It is an interesting one, Matt. We talk about that. It's a rule. It's a new ruling. It's literally like having a vehicle that goes in for a compliance or warrant of fitness and everything else, and going, okay, the government implements this law. You've got to pay these expenses, but there's no clarity of going, okay, I meet your legislation and I meet your compliance. Why can't I then, claim it all back and everything else? But hopefully over the next period of time, there will be further clarity on if it's a full or nothing. But as you said at the moment, some of it, or almost majority of it, you can claim, and some of it, unfortunately, you can't.
Yeah, and I think somewhere along the line, the government needs to look at residential property investors as the people that are providing the housing stock for the majority of New Zealand, and maybe cut them a little break here and there, especially if installing things like the heat pumps and the insulation and the ventilation. There's health outcomes there that the government then doesn't have to fund. So I think there's an argument there that it should all be deductible, but in this current environment, probably not an argument that's getting made.
Yeah, totally. As always, if you're having a listen or watch at the moment and you've got any further questions, please feel free to reach out to myself or Matt. The details will be in the description, depending where you're listening or watching today, whether it's YouTube or on any audio podcasts. But as always, thanks for joining the Daily Nugget every single day, 7 days a week, one question, 20 minutes or less. And